Glad to have every one of us here today. Okay, so real quick before we get into today's business, I would really want to appreciate everyone who has put out their efforts to subscribe to this channel. Okay, it really means a lot to me, and it shows that in one way or the other you are getting value from the content we are creating. Okay, so actually I do have a lot in store for us once we get to 200 subscribers. And for the past few days, I've been really been impressed on how we are getting subscribers. Okay, so but we can still do more, and I know we are going to do more. The numbers of viewers that are subscribed to this channel are still way behind the ones that are not. Okay, so typically we are having lots of viewers that are currently subscribed to the channel are not close to the ones that are subscribed, okay, that have subscribed already. So please do well to subscribe. If this is your first time on this channel, please do well to check out the other videos, and I hope you find them helpful and insightful. Okay, so let's get down to today's business. In today's teaching, we are going to be talking about applying institutional order flow to forex markets. Okay, and as we know, ICT mentorship for this year was really based on futures market. Okay, so but I decided to take it upon myself and share with us what I have learned uh, from the mentorship, and on the by applying them to the forex market. And if you have been following me for some time now, you will notice that most of my most of the teachings are on the forex market. Okay, we have few on futures market, but I just want to help those out that are mainly focused on forex market and how the to apply the concepts. Okay, so we are going to look at applying institutional order flow to forex markets. Okay, so let's get down to today's business. Okay, now remember, we start our analysis from the weekly time frame. Okay, so this video I want it to be fast, quick, and straight to the point as possible. Okay, so now remember, we start our analysis from the weekly time frame. Okay, we start our analysis on the weekly time frame, and that is how we get our directional bias. And if this is your first time you are hearing me say the term directional bias on, and also how to get your bias daily, you might want to check out previous videos, and to it will help you to understand it better. Okay, so before now we talked about uh, this is the Australia Aussie dollar. Okay, and this has been the Aussie dollar has really been capturing my attention for the past few weeks. Okay, so now I have been looking at this fair value gap. Okay, and this old high getting taken out. Okay, so now what I want you to do is that, remember, we do this on every weekend. So currently I'm on a weekend. Today is Saturday, and this is what I do every week before a new trading week begins. Okay, so if you don't understand or you don't know why we do this, you might want to check out the previous videos, and it will explain why we do our analysis on every weekend. Okay, so what I want you to do is try and do some markups or notations on your own before proceeding to the next slide. Okay, try and do some annotations on your own, and if it will match up with mine. Okay, so let's proceed. So now, before now, we talked about price reaching for the buy side liquidity, resting above this old high and probably into this fair value gap. Okay, but something missed my attention, and which I have come to take note of recently. Okay, and I'm going to show you what it is on the next slide. Okay, now this is what actually missed my attention, and it came to my attention recently, that was last this week. Okay, we are still in this week on Saturday actually, and this right here is a rejection block. Okay, this is a rejection block in one of, if you are familiar with ICT PDRA matrix, premium to discount matrix, you understand that this is one of the premium array matrix. Okay, so this is actually a rejection block, and viewing candlesticks from a institutional market maker perspective, we don't really pay much attention to the candles wick. Okay, we pay attention to the 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 bodies of the candle. Okay, so there is usually liquidity resting above the body of the candles. Okay, so now as you can see on this, on the last week we traded through the body of the candle, so it might not necessarily trade above the candles wick. Okay, because we still have, there are simply liquidity resting at the body of this particular candle. Okay, so and as you can see here, we have traded through it. And another thing that came to my mind, that came to my notice actually, was that we are currently at the last week of March. Okay, so this was the last week of March, so that explains the fact why this old high was not reached for. And also, although we are currently above equilibrium, okay, so we are in a premium market environment right now, and we have just traded into a rejection block, as you can see here. Okay, so I was expecting this old high, this buy side liquidity to get attack. Okay, but having taken note of this recently, I was like, okay, maybe we might not see this old high get taken out. Okay, price might just decide to reverse from here, but let's just see how it goes. Okay, so now in the previous slide I used this range, from this trading range high to this trading range low. Okay, and we are, as you can see, we are above equilibrium, just traded into a rejection block. Okay, and in this current slide I use this old high, but we might want to use this. Okay, because this is the swing high that started this whole move. Okay, so the move started from here, but viewing this price leg as a single price leg, you can also take note that this is the trading range high and the trading range low, but I'm looking at the range from this high to this low. Okay, which is the previous swing. This is the one I'm looking at. Okay, so either one you looked at it from is okay. Okay, you can see we are still above equilibrium. Okay, in both market we are above equilibrium. All right, so we just traded off a rejection block, and I was expecting, so my bias for this week actually, because we are still in this very week, Saturday, was still very bullish. Okay, it was bullish. I was expecting price to go above this liquidity, you know. So but as you can see this week, what just there was no lot of movement this week. Okay, it was just consolidation throughout this week, just consolidated. And given the fact that this was the last week of March. Okay, we are currently in April. This was the last week of March, and this is the last week of March. We are still in the week actually, so this is the last week of March, and that's explain the fact why we consolidated throughout. Okay, so we were close to the how am I going to put it, the high and the low of the monthly candle. You know, a new monthly candle was about to form, and thus creating the kind of consolidation. Okay, so I have to be honest with you guys, I did not do much of a trading this week, because the market was like, what I didn't expect this at all. I have to be honest, I didn't expect this consolidation. I expected a kind of expanding trending markets, but market just gave and did what it had to do. Okay, so but that didn't stop me for trading. I only traded on Tuesday. Okay, which is on the 29th, if I'm not mistaken. I traded only on this day. Okay, so the rest of the day I was just in the sideline waiting and watching. Okay, so so I'm actually going to share with us some of the things, some of the experience. I learned something. It's just a kind of just a matter of experience. Okay, so just a lesson of experience. And okay, so let's just get down to it. Okay, so I did a delineation. We're actually going to look at this trading days only. Okay, I actually did some trading on this day, but I want this video to be precise, short, and straight to the point. So I'm actually going to focus on this 29th of March. Okay, so I'm going to focus on it only, and let's just see how it goes. Okay, now we are going to talk in this applying institutional order flow to the forex market. We have been talking about this, the factor of time and price. Okay, we know the market is based off time and price, which is why we have specific time of the day that we go into trading, that we start looking for our setups, and also specific day of the week that we start trading. Okay, so we start trading from on Tuesday of every week, and so these are the specific time of the day that we start looking for our entries for our setup to form. Okay, so we look for our key zones around this time of the day. Okay, generally ICT taught when ICT taught this in its was one of his mentorship videos. It was between 2 o'clock a.m. New York time to 5 o'clock a.m. New York time. That is when you start hunting for the London session key zone. Okay, that's when you start hunting for your London session key zone, and you start hunting for your New York key zone from 7 to 12. Okay, and we have a 1 hour time window of New York launch hour, which is between the 12 noon to 1 o'clock p.m. New York time. Okay, so generally what I did was that I I always look at I start hunting for my morning setup between 5, okay, which is the London session opening, to generally I just start from 5 to 12. Okay, so I hunt my setup from 5 to 12. Okay, so that's how I go into my trading every day. I look for my setups around this between the London session opening and the New York session opening. Okay, so if I am not able to get an entry within the London session opening, I'll wait for the New York. Okay, so generally I always get my entry on the London session opening. So that's why I take my money trade, and I only trade once in a day. I only trade the morning session. Okay, I don't normally go into the afternoon. I've never done it, and probably I'm just satisfied with what I have normally from the London section open. Okay, so what happened actually this week was really fantastic. Okay, so I decided to be kind of I decided to be kind of flexible, and as a trader, that is one thing you should always learn. You have to be flexible in this market, and still having my bias was bullish. Okay, my bias was bullish, and I was looking at this buy side liquidity to get taken out, to price to reach for it. Okay, so this is that buy side liquidity from the weekly time frame. Okay, so now I was like, okay, I'm bullish and I'm looking for an old low to get taken out. Okay, I'm looking for attack. I'm looking for some kind of sell side liquidity to some stop run on sell side liquidity, so I can look for my long entry. So I was kind of okay. I was looking at this old high and this old low. Okay, so when I came up around the London session opening, price was currently going up. So price just traded to above an old high right here. So what is resting above this old high is sell side liquidity. I was like, okay, so I have an price trading into buy side liquidity. Sorry, price just traded into buy side liquidity, and my intentions were to go long if price should trade below an old low. Okay, the first swing low prior to London session opening, which is this very old low right here. Okay, this is the first swing low prior to London session opening. Okay, so what I want you to do in the next slide, I'm going to show you some of the annotations I did. Okay, now I was like, okay, so I put up my chart. This is the New York London session opening. Okay, so this is the London session opening, and as you can see, price just traded above an old high. So remember my bias is bullish. Okay, so actually I'm expecting a reversal of this. Okay, I was actually looking for an old low to get taken out. Okay, so but now what I'm having here is an old high, uh taken out. Okay, so I have an old high being smashed through right here. Okay, so I was like, okay, I was giving myself, I decided to be flexible and to decided to look for a counter trade entry. Okay, so I decided to trade against my bias and probably get down here. Okay, so I was looking to get out down here. Okay, so what I did was to go down to my lower time frames. What I did was to go down to my lower time frames, and I'm going to show you why I love going down and why it's important to go down to your lower time frame. Okay, so if you are the kind of person that trades a single time frame and you are looking for the best time frame to use for your intraday trading, okay, so the 15 minute is probably the best time frame for you. Okay, 15 minutes is probably the best time frame. So let's say you are a kind of individual that like trading a single time frame. Okay, so we have a run above a buy side liquidity. Okay, so this is how you would have anticipated an entry. Okay, so we have a run on buy side liquidity, so you wait for a market structure shift, and as you can see, price just trade down, and we have market structure shift lower right here. Okay, so we look for our fair value gap. So this is our fair value gap right there, and this would have been where you would have gotten your entry, gotten in. Your stop loss would have been above the first candle or above this swing high. Okay, so you would have been in right here, and your stop loss would have been above this candle or above this old short-term high. Okay, so now as you can see, price traded down, up a bit, and went down, and this was actually my target. Okay, so I targeted for this old low, as you can see, price smashed through. Okay, so you being a trader just trading off a single time frame, this would have been your entry, your stop loss, and your exit. Okay, your TP would have been right here. Okay, but I want to show us something right now. I want to show you something right now. Okay, and this is the 1 minute time frame. Okay, this is the 1 minute time frame. Okay, this is that old high right here. So price traded through. Okay, so we are looking for a shift in market structure, right? So this is where we have the short-term low, but as you can see, price traded down but didn't go below this old low. Okay, it went up, came down again, didn't trade below this old low, went up and consolidated a bit and dropped down, but no old low was taken and no short-term low was taken out. Okay, price went up and you can see smashed through this short-term low. Okay, so what did it create? What is this? Fair value gap. Okay, so we trade back. This is our entry, so our stop loss would have been, stop loss was above this, my stop loss actually was above this old high. Okay, so and so now this is the reason why I like lower time frames. Okay, the lower time frames tends to get you in the move faster compared to the the higher time frame. Okay, and secondly, it reduce your risk, okay, so now as you can see, this was the 15 minute, this was where we got our entry on the 15-minute time frame. Okay, this is that fair value gap from the 15-minute time frame. Okay, but look at where we got in on the 1 minute time frame. Okay, so we got in earlier compared to the 15 minutes. So we cut the move earlier compared to the entry on the 15 minutes, and our risk was kind of lower, small. Okay, our risk is small compared to the one on the 15-minute chart. Okay, so now that is one of the reasons I like going down to the lower time frame, and why you should practice using the lower time frames. Okay, so now the next question you might have is, how do you probably determine the lower time frame to use? Okay, so I have answered this question in my previous videos. Okay, so what I normally do is that I scale down from the 5 minutes to the 4 minutes, 2 minutes, 1 minute, 3 minutes. Okay, so what I normally do is that I scale down through the time frame until I see a shift in structure and a fair value gap being created and an imbalance. Okay, so you can actually check this price action out. You can, to confirm what I'm saying, you can go to the Aussie dollar. This is Tuesday of this. So to confirm your dApps, you can go in. This is Tuesday's opening. This is Tuesday's price action, okay, of this week, okay. So you can actually scale down from the 5 minute, 3 minutes, 4 minutes, and if you can, you know, get an imbalance, that's good for you. But for me, I got mine and the shift in market structure on the 1 minute time frame, okay. So what you have to do is that you scale down through the time frames, 5 minute, 4 minute, 3 minute, 2 minute, and 1 minute, until you get your shift in structure. And once you get your shift in market structure on that particular time frame, you look for your imbalance, okay. So this was where I got mine. And the next thing I do is I just go down to the 1 minute time frame, because I love the 1 minute time frame, and it tends to give me tight stop loss and great uh profit target, okay. So I just go down to the 1 minute time frame without bothering going through the 4, 3, 2, and okay. So I just go down straight to the 1 minute. So that's another way of how I choose my time frame, okay. That's how I choose my time frame, the lower time frame to use, okay. So now, as you can see, our risk was just 3 pips, and our reward was 38, okay. So that's a risk reward ratio of 10 to 1, okay. So this is good move, this is a good trade, okay. So this was the first trade I caught on a Tuesday, and it was actually a counter trend trade, okay. I don't normally do this, but I just decided to be flexible, and I would have wait I would have waited for this, for price to trade below this old low to look for my long entry, okay. But I decided to be flexible, and it actually paid off, okay. So my advice is that even if you have your directional bias, even when you have determined your directional bias, you can take some short-term counter trade trading, okay. But what you have to do, you have to be able to manage your risk, and because price might just continue going higher, and so it's actually risky, and trading itself is a risky something. So I would not actually advise you on counter trade trading, but that's one of the way to be flexible. And okay, it's not actually for everyone, it's just for the few that can do it and do it right, okay. And do it right, okay. So now uh this is that break of structure on the 15-minute chart, and this was where we got in. So looking at, compared our entry on the 15-minute chart and our entry on the 1 minute chart, we will see that there's a great difference, okay. So we got in on time on the 1 minute chart, okay, whereas someone using just a single time frame of the 15-minute chart would have gotten late, and we are already in the move, okay. So that is just the advantages of using the lower time frame, okay. So that's just the advantages of using the lower time frame, okay. So now going down, remember we are looking for an old low, okay. We are looking for attack someone on sell side liquidity. So this is that profit target. This was where we got out of our long entry, okay. So this is us trading below that old low, okay. So now we have taking out our profit from our sell entry. So now we are looking to get in sync for long, okay. So we wait for a shift in market structure, and actually taking this example for those that like trading single time frame, okay. So now this will be our break of structure. Price expanded upwards, just broke structure and kept expanding higher without creating much of a gap, okay. So we look at this price leg for imbalance, and as you can see, we have one here, okay. So this was the imbalance we got, this was the imbalance, and as you can see, price came back, feed it, and this would have been our stop loss, okay. This would have been our stop loss. Stop loss would have been below this candle's low, okay. So as you can see, price traded down a bit and expanded higher, okay. So now for those of us that goes down to lower time frame, okay. So now this is the 1 minute chart, and this is that old low being taken out, and this is our break of structure, okay. So we got our break of structure right there. This is a short term high being taken out, and this is our fair value gap, okay. So we have these candles high and this candles low, drawing it out in time. As you can see, we got in here, our stop loss is here, okay, was here, as you can see. So as you can see right now, we got in earlier compared to the the one using the single 15-minute time frame. Okay, so and our risk exposure is quite small compared to this. So if you have used the 15-minute chart, your stop loss will probably would have been below this, you know, old short term low. Okay, compared to this, we have tight um tighter stop loss compared to this. Okay, so and the reward is actually huge compared to the one of the 15-minute time frame. Okay, so if you have gotten in on the 15-minute chart, you can see that your risk exposure is high and your reward is kind of low compared to the 1 minute chart. Okay, so now that is all for today's lesson. So the takeaway of this lesson is actually how we trade with time and price. Okay, so these are the specific time of day that we start hunting for our entries. Okay, for our morning session trade, we look to trade for the London session between the 7 a.m. Between the 2 o'clock a.m. Okay, let's go back up, let's go back up, let's go back up. Okay, so for our London session open, we look to take trades between 2 o'clock a.m. and 5 o'clock a.m. Okay, that's when we start hunting for our morning session trade on London session. Okay, so this is actually between this 2 a.m. to 12 noon is actually our morning session. Okay, it's actually our morning session. So after New York launch hour, between the 1 p.m. okay, down to 5 or 4:30 thereabout, that will be our afternoon session trade. Okay, so now we look for our London session and set up between 2 to 5 a.m. okay, and we look for our New York session between 7 to 12. It's actually 11, but I just extend mine to 12. Okay, so this is where we look for our entries. Okay, and as you can see, I got my first entry so I got my first entry before the New York session open. Okay, so this was kind of a drive. This was a kind of how am I going to put it? This was a manipulation on prior to the prior to the New York session opening. Okay, so those that went short here, and would have traded their stop loss down here. Okay, so this was the manipulation prior to New York session opening. Okay, so this was why we have this move upwards, taking out those that trade their stop loss right here. Okay, so it attack the buy side liquidity and dropped off. Okay, so these are the time of the day you want to take note of. Okay, so we actually look for our afternoon session trade between 1 to 5:30 New York time. Okay, 5:30 New York time. So that's when we actually look for our afternoon trades. Okay, but as you can see, I don't normally trade uh the afternoon session. Okay, because this is because once you have gotten a kind of one you've gotten something out of the market during the morning section, I don't really think it's necessary to go down to the to trade the afternoon session. But you can probably trade it on a demo for for experience sakes and to learn and gain exposure on the market. Okay, so this is all for today. This is just all about this lesson. Okay, so now I'm going to say this before I round this up. I'm actually grateful to those that have subscribed to this channel so far. But if you have not subscribed, please do well to subscribe and let us get to 200 subscribers. Once we get to 200 subscribers, I'm going to create a channel for this family, and we can all actually be in the same room and share our thoughts and ideas and views on the marketplace. Okay, so it is going to be splendid and it's going to be a great experience for all of us. Okay, so remember, I'm actually learning from you as you as well learning from me. Okay, so that will be all for today. Thank you for joining us. Please, if you have found this video helpful, kindly subscribe, like this video and share it with your friends. Okay, so see you in our next trading. Have a good trading and a happy weekend.